What's going on, everybody? We are back, and today I'm going to review the top 10 dividend stocks on my watch list for June. As you know, if you've watched any of the other videos on this channel, I have a quantitative scoring system, so I evaluate stocks for 5 factors based on quality and 4 factors based on value, and then I score those factors and rank my stocks with some tiebreakers involved. So if you want to stay tuned and watch the rest of the video, smash that like button and subscribe to the channel to help with the algorithm, and let's jump in. So first, I want to review the 5 quality factors that I evaluate stocks for. First is the value line safety score. How safe is this stock? Second is the finance score. How good is their balance sheet? How much cash and debt do they have? Simply Safe dividend safety score. So this evaluates things like payout ratio, debt, history of dividend payments, and decides how safe the dividend itself is. Fourth, I look at the company's Morningstar moat, so how durable is the company's competitive advantages. And lastly, I look at what I call the Chowder-ish score. So I'm a dividend growth investor. I want yield today and more yield tomorrow. So what I do here is I add the forward dividend yield to the 5-year annual dividend growth rate, and I'll also add up to 3 points for buybacks. I cap the buybacks because they're not as consistent as dividend payments over time, so I don't want to give too much credit, but it is a way of returning cash to shareholders that I want to give companies credit for. Next, looking at the price or value factors. First, I look at dividend yield theory. This is the idea that a quality company, the dividend yield will revert to the mean. So we compare the forward yield to the 5-year average yield, determine how much upside we have in the price based on the current yield. Second, I look at Morningstars. So Morningstar is an independent analysis group that scores stocks from 1 to 5 stars, and we give stocks points based on how undervalued Morningstar thinks they are. Third, I use a service called Finbox, one of my favorite stock evaluation tools, which uses a variety of different valuation signals and then averages them to come up with its own fair value estimate. I then discount that to 85% of that number and compare the upside. I do this to establish a margin of safety. And lastly, I look at analyst fair value targets. I also discount this to 85% of the average analyst target and look at the upside again to give ourselves some margin of safety. All right, let's jump into it. Number 10, Corning Glassworks, ticker symbol GLW. So for their scores, think about a 19 out of 25 on quality, which is great. That 19 is the bar for great in my mind. And an 18 out of 20 for price. So a very good price and great quality company. Comes in at a total of 37 out of 45. They've got a 3.5% roughly forward payout yield with a 12% 5-year dividend CAGR. Their payout ratio is under 50%, coming in at 45 for next year. And the dividend yield theory suggests that we've got about 35% upside in the price here. So coming out with a really great company. Don't know if you watched the show Blown Away, but this is the Corning Glass Institute that that sponsors that show and gives away a residency at their museum. They do commercial glass as well as glass art. They do glassware like plates, things like that. They also have glass on spaceships. They are at the forefront of glass development. They're a very quiet company that's really, really awesome. If you don't know anything about them, look them up. Number 9, Best Buy. They've got a 19 out of 25 for quality and an 18 out of 20 for price. So again, just over that great bar for quality. And they've got a very good price as well. Comes in again at 37 out of 45 points. They've got a 5% forward yield. This is crazy high. A 20% 5-year dividend CAGR, a 39% forward payout ratio, and yield theory suggests it has 99% upside. So it suggests it's about half the value it should be. This is a company that has come onto my radar, storming onto my radar in the last few months, and it doesn't look like it wants me to stop buying anytime soon. Go to number 8, Texas Instruments, ticker symbol TXN. They have a perfect 25 for 25 on quality. That's balanced out by only a 12 out of 20, so a good price, but sort of at the bottom end of that range for price. Again, good for 37 out of 45 points. a 3% forward yield, an 18% 5-year dividend CAGR, and a 53% forward payout ratio. So this is a company with a good yield, a good growth rate, and a good payout ratio, suggesting that it will continue. And yield theory suggests we've got about 17% price upside in the stock as well. Moving on to number 7 is the Home Depot, ticker symbol HD, something a lot of dividend investors are very familiar with and excited about. Another perfect 25 out of 25 for quality, and a little bit better on price than Texas Instruments was, with 14 out of 20 there. That gives us 39 out of 45 total points. They've got a 2.75% forward yield, 19% 5-year dividend CAGR, 45% forward payout ratio, and dividend yield theory suggests it has a 20% upside. So Home Depot, really, really solid. If you want to look at Home Depot stock in depth, you can check the video I published this weekend comparing Home Depot and Lowe's. Number 6, Medtronic, ticker symbol MDT. This is 23 out of 25, so not quite as wonderful as some of our previous stocks. However, the price is much better, 17 out of 20. It's a wonderful company at a very good price. It's good for 40 out of 45 total points, a little bit over a 3% forward yield, with an 8% 5-year dividend CAGR, under 50% with their forward payout ratio, and dividend yield theory suggests there's a 40% upside. So this seems like a really great company at a really great price, with a good yield, good CAGR, and a lot of price action opportunity. Okay, that does it with the first half. Let's move on to the best half. Number 5, we've got Blackrock, ticker BLK. They've got a 22 out of 25 for quality and a 19 out of 20 for price. So a wonderful company at a very good price. Call that a wonderful price too. Good for 41 out of 45 points. 3.33% forward yield with a 12.5% 5-year dividend CAGR, a 50% forward payout ratio, and a 33% upside dividend yield theory. This is not actually part of my specific analysis, but you will notice that a lot of these companies are coming in at that 50% and lower forward payout ratio. So they're growing their dividend quickly. They're growing their cash flow enough to keep that payout ratio down. It's a good signal that they'll be able to continue growing over time. All right, moving on to number 4. We have StarBucks, ticker SBUX. This is another dividend growth investor favorite, and certainly one of mine. We've got a 23 of 25 for quality and an 18 of 20 for price. Again, wonderful and very good. Again, good for 41 out of 45 total points, a 2.75% forward yield, a 17% 5-year dividend CAGR, a 63% forward payout ratio. So this is actually pretty high for this list, but Starbucks is a pretty quick growing company, and dividend yield theory suggests it has a 35% upside. This is one of those companies where, I mean, the payout ratio isn't concerning. It's higher than most of the items on this list, but this is a pretty bargain price for Starbucks. As COVID lockdowns ease in China, I expect to see their growth expand, and they've put a tamper on things like buybacks, and potentially they're going to slow the dividend growth rate down in order to appease workers, but I think that is ultimately going to lead to a stronger long-term company that still has a lot of growth potential. Okay, getting to the top 3. Number 3, TROW Price, ticker TROW. This is a 24 out of 25 for quality and a 17 out of 20 for price, coming in at 41 out of 45 points with a 4.5% forward yield, a 15% 5-year dividend CAGR, a forward payout ratio of 48%, which factors in the revenue coming down because assets under management have been going down with the recent market pullback. So, I mean, that is in a projected down year, they're still under a 50% payout ratio, and yield theory suggests there's a 70% upside in its price. TROW price is looking very, very strong. Number 2, Comcast, ticker CMCSA. Another 23 out of 25 for quality and a 19 out of 20 for price. So 1 point off on the price and 2 points off the max on quality. Good for 42 out of 45. They're closing in on a 3% forward yield at 2.85. They have a 13% 5-year dividend CAGR, a 29% forward payout ratio, so super low, and their ability to sustain dividend growth going forward looks really, really good. And yield theory suggests they have a 36% upside. And quick drum roll, number 1 on the list, Lowe's, ticker symbol LOW. 24 out of 25, so 1 point off on quality, and 19 out of 20, 1 point off on price. Lowe's just did a really big dividend hike recently. It's good for 43 out of 45 total points. They're closing in on a 2.5% forward yield, an 18% 5-year CAGR, a 30% forward payout ratio. So even with the big hikes lately and potential projected slowdown in revenue due to the economy, they're still at a 30% forward payout ratio. Dividend yield theory suggests a 31% upside. This company has been raising its dividend for over 50 years and is still under a 30% payout ratio. It looks like they will be able to continue doing it for quite a long time. Okay, we ran through those pretty quick, so let's do a recap. Our top 10 dividend stocks for June 2022. Number 10, Corning. Number 9, Best Buy. Number 8, Texas Instruments. Number 7, Home Depot. Number 6, Medtronic. Number 5, Blackrock. Number 4, Starbucks. Number 3, T. Rowe Price. Number 2, Comcast. And number 1, Lowe's. So these are the stocks I've been dollar cost averaging into every week this month and will continue dollar cost averaging into through the end of the month. And then we'll recalculate my scores for July. I'd love to know which of these that are also on your list, which you think should be on this list, or any sort of bones you have to pick with my system. And we'll see you next time.